Welcome to the Property Wealth Podcast. We're thrilled to have you here with us today.
Yeah, it's great to connect with all of you.
So, have you heard about how AI, like ChatGPT, is changing the game for real estate marketing?
Oh, absolutely. It's fascinating how technology is shaping the way investors and agents reach their audiences now.
Right? I mean, the possibilities are pretty exciting.
They really are. Today, we're diving into some practical tips on how to use these tools to enhance your real estate strategies.
Exactly. And we'll also touch on some timeless principles of investing that, always hold true, regardless of technology.
Yes, like understanding your market and knowing your numbers. Those are foundational.
Definitely. Plus, we'll share some relatable stories and experiences that can help you navigate your own investing journey.
And, we'll also explore how to balance traditional methods with modern technology, finding that sweet spot.
So whether you're just starting out or you've been in the game for a while, there's something here for everyone.
For sure. Let's jump right in and start unpacking these ideas.
Sounds good. So let's talk about how, I can actually help you identify the right investment opportunities.
So, Sarah, the thing is, for folks over 40, this really is a pivotal time, right? I mean, retirement is, closer than it seems.
Absolutely, Mike. It's kind of a wake-up call, isn't it? You start thinking about how to secure that financial future, especially with everything going on in the economy these days.
Right, and with inflation creeping up, it's becoming even more crucial to think about how your investments can protect you. I mean, property has always been a solid hedge against inflation, hasn't it?
Yes, it's like when you own real estate, you've got something tangible that usually appreciates over time, right? So it can really help keep pace with rising costs.
Exactly. And I've seen it firsthand with some clients. Take Jim, for example. He was in his early 50s, and he'd been sitting on a small portfolio of rental properties. He wasn't really sure how to make the most of them,
Yeah, I can imagine.
Well, we worked together to really optimize those properties. He ended up refinancing to pull out some equity, and then used that to buy another property in an up-and-coming area. Now he's not just keeping up with inflation, but he's also creating a nice income stream for his retirement.
That's a great story. I love how he turned a passive investment into something that's really working for him.
Right. And that's key for people over 40. It's about being proactive. If you're just relying on traditional savings or a pension, it might not be enough to maintain your lifestyle in retirement.
For sure. And let's not forget the emotional side of it. I think as we age, there's this sense of urgency to create a stable environment for ourselves and our families.
Totally. I mean, leaving a legacy is a big deal. I know a couple in their late 40s who had been struggling with the idea of wealth transfer to their kids. They realized that real estate could not only provide income, but also give their children something substantial to inherit.
That's a win-win. It's like they're building a safety net for themselves while also thinking about the future of their kids.
Exactly. And what's interesting is how many people underestimate the power of real estate and their retirement plans. With the current market shifts, it's more important than ever to leverage those assets, especially as the economy fluctuates.
Right, and with interest rates rising, people might be feeling hesitant about entering the market. But if you can find the right opportunities, it's still very much viable.
Yeah, and that's where it gets exciting. You can find undervalued properties or even consider multifamily units for better cash flow. It's about adjusting your perspective,
For sure. I think it's also about timing. I've heard stories of investors who waited too long to get into the market, and then they missed out on great opportunities.
Exactly. And for those over 40, it's about striking that balance between risk and reward. You don't want to be too aggressive, but you also don't want to sit on the sidelines.
So true. And some people might feel overwhelmed by all the options out there. It's easy to feel paralyzed by choice, especially when you're considering a big investment like real estate.
Right, but that's where tools like ChatGPT come into play. It can help you sort through information quickly. Imagine having a resource that can provide insights on market trends, property values, or even neighborhood dynamics at your fingertips.
That's a game changer. It's like having a personal advisor available 24/7.
Exactly. You can generate ideas for marketing your properties, draft listing descriptions, or even engage with potential tenants more effectively. And for someone who might be juggling a job and family, that's invaluable time saved.
Totally. And speaking of family, I think about how many people want to make smart investments that will actually benefit their loved ones down the line. It's not just about making money. It's about creating a legacy.
Spot on. I've seen couples who started investing in real estate, and then they brought their kids into the fold. They'd work together on properties, teaching them valuable lessons about finance and responsibility.
That's such a great way to bond and educate at the same time. Plus, it instills a sense of ownership and teamwork, which is priceless.
Right? And it's not just about the money. It's about fostering relationships and building a family enterprise. Those values can be just as important as financial success.
And then, when you think about the current economic trends, how unpredictable things can be, it makes real estate even more appealing.
Definitely. In times of uncertainty, people tend to seek out stability, and real estate often provides that.
So as we shift into discussing strategies, it's clear that the emotional and financial benefits of real estate investing are huge for those over 40.
Exactly. And the opportunities are there for those willing to take action.
Let's dive into some practical strategies that can help you navigate this landscape and make the most of your investments.
So let's dive into some of these core strategies and rules of thumb.
Yeah, I think that would be super helpful. Where do we start?
Well, one of the first things I always tell new investors is to understand the asterisk 1% rule Newcent. Basically, this means that for a property to be a good investment, the monthly rent should be about 1% of the purchase price.
Right, so if you buy a house for, let's say, $300,000, you should be aiming for about $3,000 in monthly rent.
Exactly. It's a quick way to gauge whether a property might be worth your time. If you're not hitting that mark, it could be a red flag.
That makes sense. But what if the property is located in an area with lower rental rates?
Good question. In that case, you might have to adjust your expectations. It's not a strict rule, but more of a guideline. You'll want to consider the overall market conditions too.
So it's not just about the percentage, it's about context.
Right. And then there's the asterisk 50% rule, which is another handy guideline. This one helps you estimate your operating expenses.
Oh, I think I've heard of this one. So if you expect to collect $3,000 in rent, you'd budget about $1,500 for expenses?
Exactly. That includes things like property management, repairs, and taxes. If you stick to this rule, you'll have a better idea of your cash flow.
So really, it's about keeping your expenses in check so you can maximize your profits.
Absolutely. And speaking of cash flow, understanding asterisk cap rates asterisk is crucial too.
Cap rates, right? That's the ratio of net operating income to the property's purchase price, right?
Spot on. So if a property generates $30,000 a year in net income and you bought it for $300,000, your cap rate would be 10%.
And that's a good indicator of how well the property could perform.
Yes, generally a higher cap rate indicates a better return on your investment. But remember, a high cap rate can also indicate higher risk, so you want to balance that out.
Got it. So are there other metrics we should keep in mind, or is that enough to start?
Those are definitely the foundational ones. But I'd also suggest creating a asterisk to deal evaluation checklist. This can help you evaluate each potential investment systematically.
What would that checklist look like?
Start with the purchase price and expected rental income, then move on to expenses, cap rate, and any potential appreciation. You might also want to include factors like neighborhood trends and the condition of the property.
So it's almost like a mini business plan for each property.
Exactly. It helps keep your emotions in check and allows you to make informed decisions.
That's really smart. Now let's shift gears a bit. What about financing options?
Financing is a big one. Traditional mortgages are the most common, but there are other options too. For instance, you could consider private money lending, or hard money loans.
Can you break those down a bit?
Sure. Private money lending usually involves borrowing from an individual or a group rather than a bank. It can be quicker and more flexible.
So like a family member or a friend?
Exactly. Just make sure to have a solid agreement in place to avoid any misunderstandings.
And hard money loans?
Those are typically from private investors or companies and are secured by the property itself. They're often used for short-term needs, like flipping houses.
But they come with higher interest rates, right?
Yes, they do. So you want to be cautious and ensure your exit strategy is solid before going down that path.
That makes sense. And what about property types? Are there certain ones that are better for investors over 40?
Well, it really depends on your goals. Single-family homes are usually easier to manage, but multifamily properties can offer better cash flow.
So if someone is looking for stability, maybe single-family homes are the way to go?
Yeah, exactly, but multifamily units can be a great way to scale up your investments. You just have to be prepared for more management responsibilities.
Right. And I guess the location also plays a huge role in the type of property one should choose.
Definitely. You want to invest in areas with growth potential, look for job growth, schools, and amenities.
So it's really all about balancing your personal situation with market conditions, huh?
Exactly. And don't forget to think long-term. Real estate is generally a marathon, not a sprint.
That's a great point. So it sounds like we've covered a lot of practical strategies and rules of thumb here.
We have. But before we wrap up this section, let's touch on some common pitfalls investors might face. One of the biggest pitfalls I see with new investors, and honestly, even some seasoned ones, is over-leveraging. They get so excited about a property that they stretch their finances too thin, thinking, oh, the market's hot, I can handle this.
Right, and then what happens? They end up in a situation where if there's a dip or, an unexpected expense, they're really in trouble.
Exactly. I remember a client of mine. Let's call him Tom. He purchased 2 properties back to back, fully leveraging his existing equity. It felt great at first. But then he faced some maintenance issues and vacancies. Suddenly, he was juggling bills he couldn't cover.
Ouch. That must have been stressful for him.
It really was. And it's a classic case of not considering cash flow. People get so caught up in the potential appreciation. They forget about the day-to-day costs.
Yeah, you can't just look at the shiny exterior or the profit potential. What about bad tenants? That's another area where people can get burned.
For sure. I've seen investors who don't do their due diligence when it comes to screening tenants. A friend of mine, let's call her Lisa, rented to someone who seemed perfect on paper. Good job, great references. But once they moved in...
What happened?
Well, they stopped paying rent after a few months. Lisa had to go through the eviction process, which took months, and cost her a ton in legal fees. If she'd taken the time to dig a little deeper, maybe checked their rental history more thoroughly, it could have saved her a lot of headaches.
That's such a good reminder. It's not just about finding someone to fill the space, but finding the right person.
Exactly. And, speaking of reminders, another common mistake is ignoring hidden costs. People often underestimate things like property taxes, maintenance, and insurance.
Oh, definitely. I think it's easy to focus on the purchase price and forget that those ongoing costs can eat into your profits.
Right. I had a client, let's call him Dave. He bought a lovely property, but he didn't account for the older roof that needed replacing. By the time he realized it, he was facing a huge bill that he hadn't budgeted for at all.
That's tough. So how can investors spot these red flags early?
Well, it starts with thorough research and realistic budgeting. You need to get a clear picture of what you're stepping into. For example, hiring a good inspector can reveal issues that aren't immediately visible.
And maybe looking into the neighborhood for any signs of decline or rising costs.
Absolutely. You want to pay attention to the local market trends. Is there development happening? Are property values increasing? Or are they stagnating? A little homework goes a long way.
What about timing the market? That's another mistake I see a lot.
Yeah, I think that's a mindset trap. People try to time their purchases based on market predictions, which, let's be honest, are often way off.
So true. I've heard stories of investors waiting for the perfect moment and missing out on great opportunities in the meantime.
Exactly. A friend of mine, let's call her Rachel, waited for what she thought would be the ideal time to buy. But by the time she jumped in, prices had already skyrocketed. If she just focused on finding a solid property instead of worrying about timing.
She might have been ahead of the game, right?
Exactly. And this is where having a clear investment strategy helps. If you have a long-term plan, you're less likely to get caught up in market fluctuations.
That makes so much sense. It's about consistency over speculation.
Yes. And let's not forget about cash flow, which ties back to everything we've discussed. It's crucial to ensure that your properties are generating positive cash flow.
Totally. If you can't cover your expenses, it doesn't matter how much the property appreciates.
Right. I had another client, let's call him Jake. He bought a property he thought would be a great deal, but once he calculated his expenses, he realized he was losing money each month.
That's a hard lesson to learn.
It is, but it's also a wake-up call. The good news is, once you recognize these pitfalls, you can take steps to avoid them in the future.
So what would you suggest as next steps for someone who might be feeling overwhelmed by all of this?
Well, first, take a step back and reassess your finances. Make sure you're not stretching yourself too thin. Then, create a realistic budget that includes all potential expenses.
And definitely do your due diligence when it comes to tenants, right?
Absolutely. Invest the time in screening tenants properly. It's worth it in the long run.
And maybe even connect with other investors or join a local real estate group. That can be so helpful for sharing experiences and advice.
That's a great idea. Surrounding yourself with knowledgeable people can provide support and insights that you wouldn't have on your own.
Plus, it's always nice to have a network to lean on when things get tough.
Exactly. And remember, learning from mistakes is part of the journey. Every investor has faced challenges, but it's how you respond that makes all the difference.
So true. Well, I think we've covered a lot of ground today. It's all about being proactive rather than reactive.
Definitely. And being informed can really set you up for success in the long run.
Thanks for sharing all these insights, Mike. It's been a great conversation.
My pleasure, Sarah. I hope it helps some listeners navigate their real estate journeys more smoothly. So let's dive into some practical steps listeners can take right now.
Yeah, definitely. I think starting with tools is a great idea.
Absolutely. One of the first things I would recommend is checking out Zillow. It's not just for searching homes, you know? You can look at market trends, see what properties are selling for in your area.
Right, and that can give you a good sense of local pricing.
Exactly. Another great tool is the BiggerPockets calculator. It helps you analyze potential deals, which is super handy.
Oh, I love that one. It really breaks down cash flow, ROI, and all those important metrics.
Right, and if you're looking for rental properties, Rentometer is a great resource to determine if you're charging the right rent. It compares your property to others in the area.
That's so useful. And if someone is already invested, they might want to tap into local MLS access as well.
Yes, for sure. Having access to the MLS can give you a leg up on finding properties before they hit the broader market.
Now, let's not forget about books and podcasts.
Oh yeah, there are some fantastic resources out there. The book on rental property investing by Brandon Turner is a solid read.
I've heard good things about that one. And what about podcasts?
BiggerPockets podcast is a must listen. They cover everything from beginner tips to advanced strategies, and they interview successful investors.
That's a great recommendation. Also, Real Estate Investing for Your Future has some wonderful insights as well.
Totally. And, you know, it's not just about the tools and resources. It's also about building habits.
Yes. What would you suggest for someone just starting out?
I'd say start small. Aim to analyze one deal per week. Just pick a property, run the numbers, and see what you think.
That's a manageable goal. It makes it less overwhelming.
Exactly. And joining a local meetup can also be really beneficial. You get to network, learn from others, and share experiences.
Right, being part of a community can keep you motivated and accountable.
And remember, it's about progress, not perfection.
Yes, even if you just take one action step a week, that adds up over time.
For sure. And for anyone who's feeling stuck, consider setting aside time each week to educate yourself.
Like dedicating an hour to read or listen to a podcast, right?
Exactly. Consistency is key.
And those small steps help build confidence too.
Absolutely. Before you know it, you'll be feeling much more knowledgeable about the market and your investing strategy.
So there's really no rush. Just focus on what you can do today.
Yes. And if you have questions or need support, don't hesitate to reach out to others in the community.
Great point. Networking can really open doors.
And, of course, always keep learning. Real estate is a constantly evolving field.
So true. And with these tools in your pocket, you're ready to move forward.
Yeah, it's about taking that first step, however small it may seem.
So those are some practical first steps. Now let's bring this all together.
Well, Sarah, as we wrap up, I think it's important to highlight some of the key takeaways from our chat about using ChatGPT for real estate marketing.
Absolutely, Mike. So one big point was how I can really help streamline communication, right? Like drafting property descriptions or responding to inquiries.
Yeah, and it also allows for more personalized marketing strategies, which can really connect with potential buyers or renters. Standing out in a crowded market is so crucial.
Totally. And we talked about how it can generate content ideas too, like blog posts or social media updates that resonate with your audience.
Right, and don't forget about the data analysis aspect. Using AI to interpret market trends can give investors a solid edge when making decisions.
Exactly. It's all about leveraging these tools to enhance our investing strategies, which brings us to the bigger picture of building wealth through real estate.
And it's never too late to start, Even if you're over 40, there are still so many opportunities out there. With the right knowledge and resources, you can really create long-term financial security.
Yes, so if you found value in today's episode, please like it, subscribe to our channel, and we'd love to hear from you. What was your biggest takeaway? Or maybe you have a question about using AI in your investing journey.
And don't forget to share this episode with someone you know who's over 40 and looking to invest in property. They might find these insights just what they need.
Absolutely. And next time, we're going to dive into something exciting: drone photography for property listings. It's a game changer for showcasing real estate.
Can't wait for that discussion. Thanks for joining us today. And remember, building wealth through property is a journey worth taking.
Right? So, until next time, keep investing in your future.